it's a case, it would seem, that it was before it was don't fight the Fed, it's don't fight the markets.
Well, I think what is actually happening at the moment is that the market is actually repricing what is...
They're constantly repricing, Mo.
They are constantly repricing, but I think what they've done is certainly, the last time I was here a month ago, we were talking about this idea that the equity market might be about to push the economy into recession. Our view now is that they've actually done it. And so now what we are actually focusing on is the dislocations between different markets. So equities, where we had thought that there was going to be a bounce last time, which did happen, didn't go as far as we thought. We think there's going to be another bounce happening now, but you definitely want to be selling into this now.
Mohammed, interesting to see what's happening with treasuries, right? They rebounded and today giving up earlier gains. I mean, it is too early to call the end of that, bond route.
Yes, I think I've been wrong on that call. I thought that we've been trying to call the top in bond yields for quite some time. What concerns me, and again, this feeds back into this idea of what's happening in Japan with the yield curve control as well, is this idea that there could be a deflation cliff that is going to be facing us on the other side of all of these rate hikes. And there is this sort of scenario where, oil in 2023 or late 2023 falls, and all of the things that are positive for inflation at the moment actually turn into big negatives. So we still think that, at the moment, you probably want to be buying tactically into the bond market and looking for opportunities whenever the bond yields look a bit too extreme. But I'm not going to make a view on the bond market now, which probably means that it is probably the time to buy. But longer term, we still think that what's going to happen is that everything is going to go back to the level that it was at when President Biden got elected on the 4th of November 2020. That's equities, it's going to be bonds and probably commodities and oil as well.
Well, let's look at the Bank of Japan. I mean, Haruhiko Kuroda, term comes to an end in a few months. He's not done anything. He's just essentially done the same thing over and over again, and he's had the same result. He's nowhere near. He'll get inflation above his 2% target, but it's going to be transitory this time, isn't it?
Well, I think it is, and yeah. I think the problem.
But what does he do? Yield curve, they're doing all sorts of things, but how is it moving the needle for the economy?
I think it's the alternative that you're preventing. I think that's the major thing. You imagine this scenario where, you abandon yield curve control. The market's going to take yields up above 1% on the 10-year. The Japanese economy is just going to slam into reverse. So all those people who are, betting against that, the stakes are very high. And I think the thing is that where the Bank of Japan differs from the RBA is the Bank of Japan has got $1.3 trillion of reserves. And most of the shorts that there are in JGBs are on an unhedged FX basis, right? I'm old enough to...
that's going to hurt. Yes.
I remember in 1998 when the Bank of Japan moved dollar yen from 137 to 111 in 3 days. Now, I'm not saying that's going to happen now, but that's a real consideration that we need to be thinking about. And they will defend it if it comes down to their national interest, I believe.
But Mohammed, in 1998, the BOJ actually ran out of power. It had to seek the help of the treasuries, no? Limited FX reserves.
Well, no, not really. What it was that there was this idea, which is still around today, that you don't want to ever be doing intervention on your own. You want to get the approval of the G7 to be able to do it. Now, what we've shown previously is that from a game theory perspective, inflation can actually be controlled if you get dollar yen moving lower and renminbi yen moving lower as well. And at the moment, that's not really happened. So the higher that dollar yen actually goes, the worse it is actually for inflation around the world. And if all the central banks got together and realized that actually lower dollar yen is good for inflation, I think they'll agree to intervene together.
Right. Okay. It's Bank of England today. We've got the ECB. They face similar issues, high inflation, etc. But you look at it this way, just generally speaking, you've got low, or should I say, real wage growth slowing down. You've got at the same time economic growth slowing down. You've got high inflation in the pipeline, markets which are volatile, particularly stocks. Oil spiking, of course, particularly, and you've got also a war in a particular commodity-producing area of the world. Now, that's the 1970s. That's also now. Those things are all happening now, right? But you can't draw parallels because the world has changed.
Yes.
But markets have changed as well. So how do they interrupt? How do they interpret all this?
Well, I think the major thing that is happening at the moment is this withdrawal of liquidity and the QT that is happening. And, we've been talking about this now, particularly since March 2020, going back over 14 years as well. And I think what this means is that what is going to be really crucial to what happens to markets is going to be the direction of the dollar. The balance sheets are now so big that what happens to the dollar determines what happens to risk. And now it looks like the Fed is taking rates even higher. The dollar looks like it's going to have one leg higher as well, and that's not contributing very well. Well, it's basically the dollarized balance sheet that matters. And what you can see, even on an intraday basis, is you see a move in the dollar and you see almost a direct correspondence happening in markets. I think some of it is to do with the way that the balance sheet feeds into the credit risk and into the equity risk premium. But I don't think we completely understand exactly why it's working, but it works.
Mohammed, we talk about the divergence in monetary policy. It's not just the BOJ, but PBOC, though the PBOC is not grappling with high inflation still within its target. And that somehow makes Chinese stocks, Chinese assets unlikely haven plays. Will that persist?
I think at the moment, yes, it will. I was looking just before I came here. The HSI has actually outperformed the S&P by 25% since March 15th when China exercised its liquidity put. Certainly, if the dollar weakens, that will be a real benefit for those markets. But I think with looser policy coming from China, there's still a lot of money that is overweight in the US that will rotate from there into China. Now, of course, if the US sells off very heavily, then at some point the Chinese equity markets will also sell off. But I think that's a little bit further down the line, maybe a couple of months away before that will happen.
You talk about dollar strength, yen weakness. Surely China's looking at this really, really closely. I mean, that yen weakness not really sitting well with China, right? I mean, it erodes its competitiveness.
Yes, I mean, again, there are parallels with 1998 again here, which is that, the Chinese were getting very concerned with the yen weakness even at that time. And the Chinese have weakened their currency. It's now been stable for about a month or so, but I think they will be looking at that as well. And remember, with the domestic weakness in the economy, they are going to be looking at exports, especially within this region, to be helping to drive their economic growth.
Again, it's the dollar central. But what about corporate debt? What about dollar-denominated debt? That must be a huge concern.
Well, again,
I'm talking about in this part of the world.
Yes. I mean, I was talking to our traders this morning and I said, in 1994, when we had the great bond massacre, it was called at that time, 7 months later, you had the tequila crisis. And I said, well, what we need to look out for is who is going to be the potential victim of this. You need to be looking for people who have got high levels of debt. You need to be looking at countries, for example, with twin deficits. There are a few in this region as well, which I'm not going to name, but that's something that we are definitely on alert for.